We want to take a minute to thank our strategic partners as well as our sponsors who have helped promote the Caregivers Summit. Our strategic partners are the Alzheimer's Association of Eastern North Carolina and the Dementia Alliance of North Carolina, who provide very important resources for those trying to navigate the complexities of dementia and Alzheimer's. We're also grateful to our sponsors for their financial contributions that make the Caregivers Summit possible. An extra special thank you to our gold sponsors, the Potter Financial Group, North Carolina Senior Medicare Patrol, and United Healthcare. Because of them, there was no charge for you to participate today. Today, we'll be talking about how to pay for long-term care, and we're honored to have 3 experts to help us understand more about this topic. They are Kevin Huston, attorney with Huston Law Firm, Bill Comfort, the owner of Comfort Long-Term Care, and Ron Heath, a reverse mortgage specialist with the Mutual of Omaha Mortgage. I'd first like to introduce you all to Kevin while he works on loading his slides. So Kevin, you can go ahead and load your slides. Attorney Kevin Huston is the founder of Huston Law Firm, a law firm focusing on elder law and estate planning. Kevin is licensed to practice law in the state of North Carolina and is a member of the National Academy of Elder Law Attorneys, Elder Council, and the Elder Law and Estate Planning sections of the North Carolina Bar Association. Kevin Huston is accredited by the Department of Veteran Affairs to handle VA claims and appeals on behalf of veterans and their spouses. Kevin is also experienced in handling Medicaid cases, estate planning, and estate administration. Kevin, thank you so much for joining us, and we're excited for your presentation.
All right, well, thank you. Can you hear me okay?
We can. If you want to put your slides in presentation mode, we see like the full view now.
Okay. Can you see it okay?
We can see the full PowerPoint view. If you want to go to the present slides, like the presentation view.
If I knew how to do that, that would be helpful. Yeah. Let's see.
In the bottom right-hand corner where the little zoom button is. Yep. And then to the left, there's that little like thing on a pedestal, the little icon.
Oh, this, no, where?
Yep. To right to the left of the little subtraction sign.
I apologize. I'm not seeing it.
Yep, right there.
Oh, right there. Okay. Sorry.
There you go.
Is that better? Can you see it now?
I think it's loading, maybe. Did you click it once more?
There we go. We're good? Okay, good. Sorry about that. So, yeah, so I'll be talking about veterans benefits. It's my pleasure to do so. And so the importance of this is understanding what benefits or what income is available to help our veterans and spouses of veterans pay for care. And so we'll be talking about these programs that can help pay for long-term care or really any type of facility care or paying a private care provider. And so the benefit that I'll be speaking to is aid and attendance. And this aid and attendance program is available to both veterans and spouses of veterans. And it interacts with 2 different programs. One is compensation, the other is pension, okay? So I'll be talking to you today about the VA compensation program, as well as the VA pension program, and how this aid and attendance benefit can increase either your compensation claim or your pension claim. And again, just to reiterate, this is available for veterans, spouses of veterans, and widows of veterans. So we'll talk about how each type of claim is handled. So what is aid and attendance, first of all? Aid and attendance is basically a need for some assistance with one or more activities of daily living. And so you see on the screen here, there's 5 different activities of daily living. And if you can establish that you need assistance with one of these, you're probably good in establishing the need for aid and attendance. So as you can see, dressing, the ADL's activities of daily living include dressing and undressing, transferring or ambulating, bathing, toileting, and feeding oneself, okay? So again, if you can establish one or more of these, this can help to get money from the VA by increasing your compensation or pension plan. So All right, so first, again, there's two programs. There's disability compensation and pension. So first I'll address the VA disability compensation program. All right, so basically disability compensation is established when the veteran has a service-connected disability or a service-connected injury. And so if there's active duty service and the veteran was injured while on active duty, that's what gets you this disability compensation. All right, the disability rating can be anywhere from 10% to 100%. And obviously, the higher the percentage of your disability rating is, the more monthly income you will get. All right. So unlike the pension program, this disability compensation program has no income limits and no asset limits. So you could be quite wealthy or quite impoverished either way and get disability compensation. It's just based on, again, a service-connected disability. And if you're a surviving spouse of a veteran, there's a possibility of receiving what they call DIC, Dependency and Indemnity compensation. And that's established under a few different circumstances. The most likely would be either if the veteran was receiving 100% compensation for 10 years prior to his death, or if the veteran in fact died of a service-connected disability. So here's how aid and attendance impacts compensation. So while the veteran is living, okay, if the veteran can establish that he has a need for assistance with these activities of daily living, or if his spouse can establish a need for assistance with activities of daily living, then that would increase the veteran's compensation claim. Okay, fair enough. And that can get you, it could be often $700+ a month. It could be thousands of dollars a month actually that's added on to a compensation claim. And after the veteran's death, if the surviving spouse is receiving DIC that I just mentioned, the aid and attendance benefit can tack on some money to that claim as well. Okay. Now, to get the aid and attendance allowance to increase the compensation amount, there must be at least a 30% disability rating. It's more common that 100% more easily will get you there. All right, so that's kind of the compensation benefit in a nutshell. Again, we're looking for service-connected disability. Just realize though, if you've got, a veteran receiving compensation, or you've got a widow who's receiving DIC, they may think that's all the money that they can get because I've got my 100% rating. But that's not necessarily the case. Again, if you can establish this aid and attendance allowance, then that can greatly increase that monthly income coming into the veteran. All right. Okay, now I'll talk about the VA pension program. And so VA pension goes by a few different names that you might hear: VA pension, improved pension, non-service connected pension. And that's because, with pension, there doesn't have to be a service connected injury or disability. And for widows, it's also called death pension or survivor's pension. Now, a veteran or the spouse of a veteran cannot get both compensation and pension at the same time. They can get one or the other. And obviously, you'd want to apply for whichever one is greater. You can apply for both and see how it shakes out as far as which benefit gets you more. And again, aid and attendance can increase the amount of either compensation or pension. And there at the bottom of the slide here, it shows the maximum monthly rates for a pension after you include the aid and attendance allowance. So if you've got a pension with aid and attendance, for a married veteran is $22.95 monthly income, $1,936 for a single veteran, or $1,244 a month of income for the widow of a veteran. All right, it's tax-free money, it's payable monthly. And it is adjusted yearly. They do a cost of living adjustment each year. So there's 4 criteria that I want to mention for this pension benefit, and they're listed here. One is wartime service. And again, this is wartime service for the veteran, but it's a fit for either the veteran or the spouse of the veteran. There's also an asset limit of $130,000 roughly, $130,773. That's a 2021 figure. They do adjust that upwards each year with a cost of living adjustment. And then there's income qualifications. And the income qualification is derived from taking the gross income of the veteran and subtracting the unreimbursed medical expenses. We'll talk about that. And then you have to be age 65 or disabled is the fourth criteria. I'll go through each one of these criteria now. So for the service requirement, fairly simple. You have to have, generally speaking, at least 90 days of active duty service, and just 1 day of that must be during a wartime. And so 1 day wartime, at least 90 days active duty typically. For all these benefits, you cannot have a dishonorable discharge. So anything other than a dishonorable discharge will get the job done. It just can't be dishonorable. All right, for the age and medical criteria, there's 4 ways to get that, to qualify under that criteria. Any one of these, at least 60, you could be at least 65 or older, have a permanent disability that's recognized by the VA. You could be a patient in a nursing home or a long-term care facility, or you could be getting Social Security, disability insurance, or SSI, which is supplemental security income. So either one, any one of these will qualify under the age and medical criteria. I mentioned that the asset limit is $130,773, and again, that's a 2021 figure. That asset limit would apply to the veteran or the spouse of a veteran, either one. It applies to both the spouses, the veteran's assets, and the veteran's spouse's assets altogether. You can subtract debts from that as well to arrive at a figure that may be lower than that. So debts can reduce that asset figure. Now, there are some assets that the VA does not count. You might call these non-countable assets. Your house is non-countable for up to 2 acres. If you have more than 2 acres, they will count the value of the acreage above that. If you've got a burial policy or like a memorial plan, that would be exempt. Life insurance policies should be exempt. Household furnishings, personal effects are exempt. And any motor vehicles used for transportation are also exempt. Now, it used to be the case up until 2018 that you could transfer assets and qualify for the VA pension benefit. Now you kind of have to do that 3 years in advance, because when you apply for VA, they ask what assets did you give away in the last 3 years. And if you've given away assets, they will penalize you for the VA benefit, the VA pension program. But you can use strategies like sheltering assets by converting countable assets to non-countable assets, such as putting money into paying down your mortgage or home improvements, let's say buying a car, prepaying for funeral. These can reduce your assets by making your assets non-countable. And then let's say if you own a house, and let's say maybe you're going into assisted living and you're thinking, yeah, let's get some money from VA to pay for that assisted living or memory care or skilled nursing care, whatever. So you can put the house into an irrevocable trust and then sell the house, and that works perfectly fine, because the VA says you can give away assets that are non-countable, and that would not penalize you for VA. So whereas if the house is in a trust and you sell it, the proceeds are non-countable. If you were to sell the house, well, that's a problem, because now you've got a lot of cash that's going to push you above the asset limit probably. So there's a few things you can do for sort of sheltering assets to qualify for VA pension or stay eligible for the pension. Now, on the income calculation, basically, it doesn't really matter so much what your income is as much as what is your income left after you've paid out your medical expenses. So again, they're taking gross income from the veteran and the spouse of the veteran and subtracting care expenses and medical expenses to arrive at the actual income amount, okay? So basically, by paying a care provider, by paying a facility like assisted living, memory care, skilled nursing, that's a medical expense that would reduce your income for VA purposes. And so a lot of people end up, paying money to a child or a family member even, and the payments to your family member would reduce your income for VA purposes and would probably get you then within the income limits that you need to be under. So if your medical expenses exceed your monthly income, then you would qualify and get the full pension benefit. On the other hand, if your monthly income is greater than your medical expenses, then you might get a partial benefit. And what would happen there is they would likely reduce your monthly pension amount that you receive. They would just reduce it dollar for dollar by how much your income exceeds your medical expenses. Okay, I hope that makes sense. But the idea is, medical expenses reduce income for VA purposes. And so, paying the facility, paying the care provider would allow you to meet this test of, the income criteria. So that's basically it. Those are the 4 criteria: wartime service, age 65 or disabled, and then the asset and income limits. And if you can establish again that you've got the aid and attendance, that need for aid and attendance, that gets you to the maximum amount on this chart. So for a veteran needing aid and attendance, it would be $19.36 a month for a single veteran. If that veteran is married or has a dependent, it would be $22.95 a month. And I'll close with this. For a surviving spouse, the maximum benefit for VA pension with aid and attendance is $12.44 a month. Tax-free monthly benefits.
Wonderful. Thank you so much, Kevin.
Take today's time with you to primarily focus on how long-term care insurance works at the time of claim. So as a caregivers summit, as a caregivers meeting that we're a part of here today, you're maybe helping another family member, perhaps a parent. And if that other parent or family member who needs care has long-term care insurance, hopefully some of these things that I'm going to share with you might help you navigate the claims process. There's also some good information if it's something where you might be looking to purchase long-term care insurance. A little different criteria is there, and I'll touch on that. I heard a number of years ago, probably 25 years ago, someone said, and it stuck with me then, to understand long-term care, LTC insurance, think of it as describing look to claims. And that's an important perspective. Just a quick note, if you're considering buying long-term care insurance or you'd like to look at the costs or the options, you have to plan ahead. You have to buy it when you're healthy. There are medical underwriting qualifications. So you can't wait until you need care to buy the insurance. So it has to be a plan ahead. Work with somebody who's independent, represents multiple companies and different ways of doing things. And part of the process is figuring out what's enough, what's both meaningful coverage and affordable. Now, in looking at claims, one of the critical things is to get a hold of the actual policy. If maybe your folks don't have their old policy still, maybe they just have a collection of bills and things, you can call or write to the insurance company and get a new copy of the policy. And it's really important to be able to see the entire policy with the definitions as you're navigating some of the various provisions. And what I want to focus on here in the limited time are the 3 biggest challenges or the 3 most important things to understand when it comes to filing for requesting benefits, filing for claims and requesting benefits with long-term care insurance. First up, nothing happens in a policy until you're benefit eligible. And a way to think about this is it's a definition of disability. In long-term care, they talk about impairments or limitations, but it's really describing a degree of disability. A lot like Kevin mentioned being the criteria. And you'll see that those activities of daily living are really identical as part of the criteria for qualifying for long-term care. So nothing else happens until you're benefit eligible. And it's again, impairments, a disability, if you like, functional disability. And here's an easy way to think about it. Is the person who perhaps needs care, needs to file a claim, are they struggling to safely get through the day? either physically, which we measure by those activities of daily living, or mentally, cognitively. We think of things like Alzheimer's or dementia, could be a head injury or a stroke that has caused mental and cognitive functioning. In long-term care insurance, the policies identify 6 activities of daily living. Again, you'll see these are very similar to the veterans aid and attendance. By the way, these can work together. And if you have someone who's a veteran, you really need to start with Kevin, because he can help you navigate those benefits, and then look at how the insurance could fit as well. So long-term care insurance looks at these 6 physical functioning activities and generally says most policies, unless the policies before maybe 1995, 1993, the policies say if you need help, if you need assistance completing any 2 of these 6 activities, you can be eligible. Now, here's something interesting to be aware of. Again, almost all policies, certainly those written in the last 25 years, maybe if it's very old, before 1993 or so, it might be hands-on only. Somebody has to physically help pick you up. But most long-term care insurance will measure your need for help or the assistance by what's just called standby assistance. Someone needs to be close by to make sure you're safe when you complete the activity. That's standby assistance. Perhaps it's balance or fall risk, or something like that. Brittle bones, osteoporosis, where a fall would be very, very harmful and impactful. Just standby assistance. And what I like to tell both my clients and other financial professionals I work with, long-term care insurance can start paying a benefit long before you're flat on your back in a hospital bed, unable to do anything. Standby assistance, just making sure that you're safe completing at least 2 of these physical activities. Or, now this is a completely separate track. They don't link together. So a cognitive impairment, a mental limitation, again, we think of things like Alzheimer's or dementia. It's a measured loss of short or long-term memory, your awareness of who and where you are, your judgment related to safety issues, and it's measured through some fairly simple standardized testing. And what the policies say, if you need supervision, if you need someone around to observe, supervise, guide you to make sure you're safe, that would qualify you for benefits as well. Now, in the last 20, 23 years or so, the criteria has been substantial supervision, which is generally someone around all the time, or at least most of the time. So if someone has very early stage dementia and they just need a check-in once or twice a week, that hasn't risen to the level yet. But if you never know when there could be a problem because of the limitations and impairments cognitively, you're never sure when there might be a problem, somebody needs to be around, at least observing all the time, that meets the criteria. By the way, the supervision does not have to be paid professional supervision 24/7. It could be the spouse most of the time, but the spouse needs a break. The spouse needs a good night's sleep, and that's where the insurance can help pay for professional care. The second criteria after you are benefits eligible is what's called the elimination period. It's kind of an unfortunate term. It's really the policy's deductible, and it's usually stated in the policies as a number of days. 30, 60, 90, 180 days are most common. And it simply means once you need care, once you're eligible, this is the period of time that you have to take care of yourself or your family take care of you, pay for care yourself until those days passed. It's not based on a dollar amount. It's based on needing and receiving care. But we have to be careful, because if you go straight into a facility, assisted living or nursing home, every day is going to count because you're there and getting care every day. But if your claim, your need for care is going to start at home, you got to be very careful. Calendar day elimination periods just count your days of impairment, no expenses. Service days, which is the most common, if you only hire a paid caregiver 3 days a week, it could take you over 7 months to accumulate those 90 paid service days. So you might consider getting paid home care at least for a few hours every day of the week to help satisfy the elimination period. And some policies with home care give you some credit if you just have 1 or 2 days a week as well. The last thing to look at the very beginning of a claim is what kind of care is needed, what kind of care do you want for yourself or for your loved one, who or what is covered, and how. The contract language is critical here. What does the policy say is covered? And this is usually easy to identify initially from the schedule page. The first 1 to 3 pages in the policy will say nursing home benefits, assisted living benefits, home care benefits, if that's included. And then deeper in the policy, it will discuss how each of these are defined. If it's not named in the policy, it's not covered. Again, some older policies back to the mid-90s or maybe older, they might be facility only. They might be nursing home only. The good news is most companies that are nursing home only will typically also pay for an assisted living facility, but they won't pay for home care. And that's often a frustration. Well, why won't it pay for home care? Because it wasn't purchased, it wasn't built into the policy. So that's the first thing to look for. And then the other thing that's often an issue is if home care is covered and you're wanting to bring professional paid care into the home that the policy would help pay for, how or who is provided as a home care provider? And here again is where it's critical to actually have a copy of the full policy. If you need help understanding the language, I provide that service with clients and folks that I work with. Kevin, as an attorney, can probably help you look at things like that as well. Kevin, I'm sort of speaking for you there, but I know a lot of times it's like these words seem to be in conflict. How do we make that work? So, there's resources available that can help you navigate if you'll just reach out to us. Most policies will cover a licensed agency. Most policies will also include what's called a non-medical or a custodial agency. They don't do any Medicare billing at home, for example. The good news is in North Carolina, non-medical, just custodial care helping home care agencies, they're licensed by the state, and that really helps get the coverage paid from most long-term care insurance. A few policies, it's rare, but a few policies will also cover a separate, independent, non-agency connected individual aid or caregiver. It is not common that family members can get paid. But again, look in the contract for what it may say. So just kind of a last thought here about claims and claim timing. And I realize this is a lot of kind of detailed information. And if you're stuck or frustrated, maybe with a family member's long-term care insurance claim, please send me a note. Often we can help untangle some of that concern just by looking carefully and quickly at some definitions. But let's pull all this together, particularly for a new claim that's just starting. What's the timing? My advice is always file as soon as possible. There's no penalty if you file and they determine that your loved one's not yet ready for claims. But you have to get through that elimination period. You've got to pass the eligibility review, then the elimination period runs. Most policies are called reimbursement policies. So you pay the agency $3,000 for home care. The agency can help submit those bills to the insurance company. The insurance company reviews, makes sure they're covered services, and then they reimburse you and send you a check. So if you have a 90-day elimination period and the benefit eligibility, and then the first month of care receipts come in, which have to be sent to the insurance company, it is very common for the start of a claim for you to be getting your first claim check in 4 to 5, if not maybe 6 months. Now, once that happens, month in and month out, the benefits will continue to roll. But just be aware of that as you would start a claim that way. So hopefully I've touched on a few things that might help direct you to look for some things in your policy. I would love to be a resource for anybody that's feeling stuck or needs some help or wants to look at this coverage for themselves for their own planning and to add to this information here today.
Thank you so much, Bill. That was a great overview. We do have a couple questions, and just a reminder, if you have any questions for Bill or any of our presenters, please put them in the Q&A section of our Zoom call. But we have a couple questions for you. When should someone start the claims process?
Yeah, my advice is if you think yourself or your loved one, if you think they may be eligible, start it then. It can be a long process, and walking through the different steps takes some time. Getting the paperwork in, getting doctor's records, getting facility or home care agency notes submitted to the insurance company to prove the eligibility. That can take some time. So I would recommend starting sooner rather than later. I've worked with some folks who have said, well, we only have like a 3 or 4 year policy, and we're not sure we want to start using that pot of money yet. We might save it until care gets more expensive later. That's okay, but my advice is start the claim now, get the approval, get through the 90 days, especially if it's home care that might be less expensive. And guess what? Once you finish the elimination period, most policies, you never have to do it again, and then you can put it on pause. So you might wait a few months, or maybe it's a year and care's now costing more expensive. Now all you have to do is reconfirm the person's still eligible, and you start right away because you already made the other steps. So my advice is always start sooner rather than later in terms of filing the claim. Now, what are the circumstances of the help and the impairment? That's something that is a little more individualistic.
Thank you. Another question for you. Is there any penalty if a claim is denied?
Yeah, great question. These policies are all guaranteed renewable, which means as long as the premium continues to get paid, the company, no matter what, age, health, claims, they cannot end or cancel the coverage. So again, another reason that if you file a claim and the company says, yeah, Jane is not yet eligible, there's no penalty. You just found out, okay, we're not there yet. You know, the impairments, the limitations haven't progressed far enough yet to qualify. There's absolutely no penalty, no loss of coverage, no increase in premium because of any individual condition like that. By the way, Once you go on claim, particularly once you get past your elimination period, most policies at that point will then waive or forgive the premiums. Another reason to start the claim sooner, you may go on claim and then you stop paying premiums as well.
Wonderful. Thank you so much, Bill, for your time.
You're welcome.
All right, so now we'll move on to Ron. I will give a short introduction to Ron while he loads his slides. If Ron, you want to go ahead and take control, I'll take a minute to introduce you. Ron is a reverse mortgage specialist with the Mutual of Omaha Mortgage. Over his 14-year career, he has helped hundreds of homeowners safely use their home equity to create greater financial security in retirement. Ron Heath is a North Carolina native and has been married to his best friend, Becky, for 37 years. It's a long time. Ron enjoys traveling with Becky and gardening. Thank you so much, Ron, for joining us today.
Thank you for having me today. I really look forward to sharing this information. And just as an aside, I always have to give Becky a shout out because she's been the biggest supporter of me in this career. So I always have to throw her in there. So as mentioned, I'm with Mutual of Omaha. I do reverse mortgages. It's the only mortgage I do and have ever done. So I do consider myself an expert in this field, but I'll go ahead and talk about the program, the nuts and bolts of it, how it works, how to understand obligations and things like that. And then we'll address how people use this to provide care within their home. So what is a reverse mortgage? Well, it's a federally insured loan through FHA. It allows a homeowner to convert the equity that they built in their home into tax-free cash that, in this case, we're going to talk about using for home health care. When you start a reverse mortgage or put one in place, there are different ways that you could take the proceeds. There is a lump sum option, which is often used to eliminate a traditional mortgage, thereby freeing up cash flow from a traditional mortgage payment can be redirected towards the care or payment for the care. There are those who will establish a line of credit early on in the loan program and allow that line of credit to grow and build, anticipating a need in the future, perhaps for medical attention in the home. The nice thing about a line of credit in a reverse mortgage is, unlike a typical home equity line of credit, this line can never be reduced, it can never be frozen, it can never be taken away. As mentioned already, it's insured by the federal government through FHA, so it's guaranteed to always be there for the homeowner. Some people choose to set up a monthly payment based on the equity in their home that would come to them the first of every month if they know they have a dedicated amount that they need on a monthly basis. And you can also combine any or all of these depending on what the need may be. Who qualifies for a reverse mortgage? Well, anyone who's 62 or older. And if we have a couple where at least one spouse is 62, they too can also use a reverse mortgage. The home must be their primary residence, so they have to occupy the home at least 6 months and a day out of the year. And then based on the age of the youngest borrower, there is a certain amount of equity that you must have in the home to qualify for the loan program. What are the typical qualifications? It's quite different than getting a traditional mortgage. We have minimal income and credit requirements. There's also a counseling session that the borrowers would have to go through so that they get the same information from a third party who's unaffiliated with the lender or with the federal government. What do homeowners have to do if they have a reverse mortgage? What are their ongoing obligations? Well, as mentioned, they really have no obligation to the mortgage, so no payment on that. But as any homeowner in retirement, they do have to pay their taxes, maintain homeowners insurance. If they have a homeowners association with required dues, they want to pay those. And it's expected that they would maintain the property to minimum FHA property standards. When would a reverse mortgage loan have to be paid back? Well, the typical situation is that the last of the borrower has passed, the home then passes to the heirs. At that point in time, the loan, the amount of money that was borrowed, the interest that may have accrued, it would typically be repaid through the sale of the home by the heirs. Any net sale proceeds after the loan is paid off are certainly for the heirs to keep. Another situation that would call would create a need for the loan to be repaid is if the last borrower has vacated the property for medical care and they are out of the home in a nursing facility for a period of 12 months or longer. The lender would consider that they have now vacated the property, and so they would ask that the loan be repaid, again, typically through the sale of the home. Since a reverse mortgage is just a lien against the property and the homeowner owns the home, if for some reason they decide to sell in the future after securing a reverse mortgage, it would be expected that the loan and any interest would be repaid through the sale proceeds of the home. So let's talk briefly about how a reverse mortgage has been used, is being used, and will continue to be used for providing this long-term care or in-home health care that somebody may come to need. There are those, as Bill said earlier in his presentation, you know, a measure of health has to be there so that somebody could qualify for a long-term care insurance policy. And there are those who at the age of 62, 3, 4 have made the decision to retire, perhaps have not secured long-term care. They can use a reverse mortgage to create an auxiliary source of income that would help them to make the annual premiums for a long-term care policy so they could go ahead and take one out. There are also individuals who are moving into retirement that do have long-term care, but because now going on to a fixed income, they may use a reverse mortgage again to provide the additional income to continue the payment of their long-term care premiums. And then there are those who, again, young in retirement, may have an existing mortgage. They can use a reverse mortgage to pay that off. And in doing so, they free up that cash flow now to direct to either ongoing long-term care premiums or towards the obtaining of a new long-term care policy. So that's a step that we don't see often, but people do use a reverse mortgage perhaps in one of these situations. More often what we see is a homeowner who has their home perhaps free and clear. They've gotten into their 80s and perhaps they're starting to need some assistance at home. If they can determine what their monthly needs will be as far as what the cost of this care will be, they could use a reverse mortgage, as mentioned earlier, to establish a monthly payment that gives them this additional income to help them pay for this assistance or this home care that they may need. They also can establish that line of credit that we talked about. Now, we talked about somebody very young in the program, maybe 62 or 3, setting up a reverse mortgage line of credit to use in the future. But there's also those who now have developed an immediate need for this home health care. They too can set up a line of credit and then draw from that as needed to pay for the care from time to time as they need the additional income. I didn't put this on the screen, but I do often meet people that even in their late 70s and 80s are having to make a payment on a traditional mortgage because of refinancing. The reverse mortgage can then also help to retire that debt so that the cash flow that has been going to mortgage payments can now be used to help them navigate the cost of in-home care or assistance in the home. So those are just some brief ways on how a reverse mortgage can be used to help pay for home health care. Oftentimes I find that the one who's contacting me in this situation is the child of someone who is now in need of this care, perhaps because of mental decline or physical disability. The child is trying to figure out how to keep their parent at home and still be able to pay for the cost of this. And this is when a reverse mortgage has really become a blessing to many families that I've worked with.
Oh, wonderful. Thank you so much, Ron. Darcy, do we have a few questions from the audience?
Okay, let's see. Sorry about my computer glitch right there, but I tell you what, Doug is on it. We are going to get recordings no matter what. Yes, so we have a question. How much of the equity can a homeowner borrow against?
Yeah, it's a very good question. So it's always tied to age. The younger the borrower, the lower the percentage of equity they can borrow against. The older the borrower, the greater the percentage of equity, because the loans are built on life expectancy. And so typically a 62-year-old borrower with today's interest rates would be able to borrow about 40% of the home's equity. And somebody who is 90 is probably going to be able to borrow about 65% of their home's equity.
Great, thank you. And how long does that loan stay in force?
It is not like a traditional mortgage. It will actually be tied to the 150th birthday of the youngest borrower. So in essence, the loan really never terminates during the lifetime of the borrower.
Okay, wonderful. Do we have time for another question?
Yes.
Okay, great. Ron, will my heirs get anything when they sell the home?
Yeah, that's a good question, Darcy. Many people think that the automatic end result of getting a reverse mortgage is that there's nothing left as far as the home legacy for the heirs, and that's just not true. It all depends on how long they live, how much they borrow, and certainly it will depend on home appreciation and what has happened during their lifetime while they lived in the home. But typically what I find with the heirs that I work with when their parents have passed is there's a measure of equity left in the home, so that when the heirs sell it and they satisfy the debt, they will have sale proceeds coming back to them. It's just, there's really no way to determine it since there's so much that's unknown about the end.
Okay, thank you. Ron, would you suggest a reverse mortgage if the intent is to keep the home in the family?
Well, I would have a very, very serious conversation with the borrowers because the reality is, as time goes on, the financial needs increase as we get older. And so the use of a reverse mortgage will become more consistent as time goes by, which means the debt on the home is growing over time. And so it may be a difficulty for the heirs to keep the home depending on how great the loan balances come, because they're going to have to refinance it if they want to keep the home, and that could become a difficulty. So most of the time I'll encourage homeowners, unless there's no other option, I'll encourage them maybe to look a different direction if they truly want to keep the home in the family.
Okay, thank you. And then this is just a clarifying question. Later in life, when the mortgage is paid, can a line of credit be established to pay for care?
You mean a traditional line of credit?
It may, I'm not sure if the question was about a home equity line of credit or a traditional one. I'm not sure.
So as far as my mortgage goes, if somebody has paid for a home and they've satisfied, let's say, a 30-year mortgage, and now they own the home free and clear, yes, they can set up a line of credit, and the percentage will be based on their age that they could use. And the nice thing too about a reverse mortgage line of credit is, as I've mentioned, it can never be frozen, reduced, or shut down, taken away. That's not like a traditional line of credit. A lender on a traditional line of credit could do whatever they want with it. They have the right to freeze it, reduce it, or cancel it. Reverse mortgages can't. They have a growth factor to them, but the reality is somebody who uses this, they can treat it like a traditional home equity line of credit, in that if they choose to make voluntary payments towards the debt during their lifetime, they can do so without penalty. As they make payments, it recreates the line of credit. It's an interesting twist to it, but it gives you a flexibility that you're not afforded with a traditional line of credit.
Wonderful, thank you. Now I'm going to ask this question, and forgive me if you spoke about this earlier when my computer was not with me. What happens when a home is sold if the parent has already exhausted the entire proceeds from a reverse mortgage and the value of the home is less than the proceeds of the original reverse mortgage?
Excellent question, and that does happen. So heirs inherit a home. The loan balance has grown to an amount that is in excess of the actual value of the home in the future. Since it's FHA insured, the loans are non-recourse. And so the heirs have the legal right to sign a deed in lieu of foreclosure and simply walk away from the property with no financial obligation on their part. No judgments can be rendered even against the borrowers if it happens during their lifetime. But more importantly, no judgments can be rendered against the heirs or the estate. And then ultimately, the heirs also have the option of being able to purchase the home for 95% of whatever that future value may be. Any of the debt that's in excess of that 95% purchase price is simply cared for by FHA. It's not a responsibility of the heirs.
That's comforting to know. All right. Well, thank you, Ron. That exhausts our questions for you. Thank you so much.
Thank you.
We want to thank our guest today for this excellent review of how to pay for long-term care. This session was recorded. We did have a small glitch at the beginning, but we will get them posted as soon as possible. It might not be by the end of day today, but definitely in the next day or so. A reminder that our next webinar will be Thursday, April 22nd, also at 2 p.m., where we will cover Medicaid benefits for nursing home care and what Medicaid managed care means to you. I encourage you to join us next Thursday. Your registration and Zoom link that you received for today's webinar will be good for all 4 weeks. So you can use that same link again next week. If you have any questions, please email us at summit@transitionslifecare.org. Once again, that's summit@transitionslifecare.org. This webinar will be posted on our website when that recording does come available on caregiversummit.org. Thank you so much, and we look forward to seeing you next week.